Hello and welcome to the Phoenix Trading Academy, the ultimate guide to daily bias. I'm the Nomadic Trader and thank you for clicking on the video. This is actually going to be quite a comprehensive video, so definitely recommend that you get a pen and paper. You're going to want to take some notes. And this is the featured topic, the first on my channel, my YouTube channel in general. Some of you may or you may not already know. What I do is I'm focusing on upskilling new and aspiring and also experienced traders that are still trying to get across the line. And what I will do is each and every week I have a feature topic video which is called Market Maker Mondays, where I review the previous week's price action and then I give you my anticipation into what I believe is going to be happening into the following week. My predictions have actually been getting a lot of traction and the success rate for them is actually quite high. So I think that's definitely something that you need to be paying attention to and incorporate that into your analysis. And this video is effectively going to be giving you the secret sauce to what I use to reach those predictions. So without further ado, let's cover a bit of an intro. So our objective as a trader is to extract consistent profits from the market. In order to do this, we need to deploy a strategy that's got a positive outcome, and we need to have the confidence to execute it subjectively, without emotion or hesitation, every single time that it presents itself. We need to remember that every trade is unique and the outcome potential of that trade is always going to be random. Okay, so nothing's guaranteed. Things can happen in the market. You're not always going to get it right, and try as you might, you are going to lose. But what we do is we take comfort knowing that over time we make money based on making more money than we lose. So first of all, obviously, we need to try and understand where the market has been and where it's likely to head next. And this is actually going to give you your daily bias, or as I was actually taught to call it, the DDP, which is your daily directional prediction. So at the beginning of the week, when the markets are closed, you will have an idea of where that weekly expansion is going to go. And then within that in mind, you identify your key levels. First, in the beginning of the week, it might be expanding higher to go lower or the opposite. And within that framework, you'll also reach a DDP. Where's it likely to head that day? Where's it going to go to before it reaches that objective? So some of the concepts included in this, and before I jump into that, actually, small disclaimer, I do assume that you're already going to have a basic understanding of market structure, candlestick formations, as well as the ICT concepts within this. This isn't a regurgitation of ICT concepts. This is how to use those concepts in line with my experience in the market and how to bring it all together to reach a framework or a narrative on the higher time frames. So we will cover different market conditions, what a trend looks like, what a range looks like, which is a sideways trend, and then obviously a type of market condition that we do want to try and avoid, which is just choppy and unclear consolidation. We will go into the dealing range and how we can use the dealing range in line with premium versus discount to give us those potential swing points in the market to trade between. Range expansion isn't covered in this, but simply put, that could be the beginning of the week is at the low, and then we're expecting that weekly candle to expand to the upside. That's range expansion. And then within that, the blueprint or the mechanics of that weekly candlestick or the daily candlestick, you have your power of three. Again, another concept from ICT that I don't cover. What I do cover in this in more detail is deceleration as well as indecision. And then also 1, 2, 3 swings, which is simply a swing high or a swing low. And the reason why I call it a 1, 2, 3 swing is because it takes 3 candles to actually produce a swing high or a swing low. And the PD arrays that I actually use are order blocks, fair value gaps, and old highs or lows, which includes equal highs and lows as well. and then an overview of what a run looks like, and also versus a trend on the subordinate time frame, and also how they can both coexist across multiple time frames. And then also the lower time frame reversal that we actually use with a higher time frame framework and narrative. And then the outcome of all of those different principles is the DDP. So first off, market conditions, trend, nice and easy. The trend is your friend and all of that. So a trend is a clear direction in price where you can identify it's either going up or it's going down. If it's going up in an uptrend, we have higher highs and higher lows, and the opposite is said for a downtrend. We've got lower lows and lower highs. Market condition range. So in this one, which is a sideways trend, you still have a clear direction in price, and that direction is sideways. It takes at least 2 touches of the upper and the lower boundaries to confirm the range, and it's nice and simple. It's just sideways in movement. And this is the choppy indecision, so consolidation, and arguably we could say that arguably we could actually say that it is meandering and there are different trends within there, or if it is moving sideways. But you can see that the difference between that market condition versus that market condition. And personally, I would definitely recommend to avoid just outright choppy price action. Wait for better conditions, or just simply move to a different instrument. So with the dealing range, we've actually got the dealing range high and the dealing range low, which is your current dealing range. So if this is in a downtrend, as we see here, we have lower lows, lower highs, and we've actually got that lower high, which is creating the dealing range high, which expands to the downside with a daily run, and that produces the bottom of the dealing range low, and then we have a retracement back up into a premium. So we're blending the two concepts of the dealing range as well as premium versus discount, and that is something that we need to consider on all time frames within the framework or the context of the trade thesis. So we're looking to buy when we're in a discount, and we're looking to sell when we're in a premium. And what we'll be looking at doing is, if you notice at the bottom of that dealing range, you've got a swing low, and price is running to the upside back into a premium. And as we start to reach a premium, we're looking at pairing PD arrays with the deceleration and the swing high in this example to give us obviously that market reversal back to the downside. And I will cover this in a little bit more detail, but as you can see in this example, where we've actually confirmed the dealing range low, we're now moving to the upside, and we've got 1, 2, 3, 4 bullish daily candles. We don't expect a reversal in price against that direction, that bias, until we approach the PD array, okay, or if we actually see a swing high form at that key level or that PD array. And then we've got deceleration and indecision. So if we have a look on the left-hand side, we've got expanding candles to the downside, which will give you acceleration in price. Okay, so as the momentum comes into the market, you get acceleration from its starting point. And then we have a brief pause in the middle there, that up candle against all the other down candles. And then we have a continuation to the downside. But if you notice the difference between those lower half of the range candles compared to the upper half, we've got clear acceleration at the top half, and then at the bottom half we've got clear deceleration where we're getting wicks from the bottom. which is an indication that we're starting to slow down in momentum. And then we've also got smaller range bodies of the candles as well. And what we do is we use indecision candles, things like dojis or hammers, pin bars, call them what you will. And again, I'm going to assume that you've got a basic understanding of candlestick formations. And what we would do is we'd actually pair the deceleration with the key levels. So in this example, on the right hand side, you can see that we've got the old highs, which is it's actually giving that horizontal line, and then the red arrow is where we've actually taken the buy side liquidity with different principles. So you've got your deceleration into that level, you've got indecision candles, you've got a swing high, and then a market reversal back to the downside. So indecision at a PD array is an indication for potential reversals. So we use all of those concepts and we blend them together to help us with our bias. So 1, 2, 3 swing. It's a 3 candle formation. ICT cover these in great detail. So an aggressive entry would actually be on candle 3 in anticipation of its formation. A higher probability trade is you wait for candle 4 to trade through candle 3 in the new direction in price, and that is actually your full confirmation. We don't just randomly expect these in the middle of nowhere because they're not high probability. We are only really looking to take note of these for reversals, whether it be short-term or long-term reversal, at key levels on the charts. And then here we've got a run, which is a trend, and a trend is a run. So on the left-hand side, we've actually got a weekly run, which is made up of 4 candles to the upside. And as you observe that, that's just one clear movement up in price. However, when we've actually got that on the daily time frame, which is obviously it's 1 time frame lower than the weekly, we will have ebbs and flows. So you're going to have more movement against the overall trend, which is a counter trend move. So you've got ebbs and flows, it goes up, it comes down, and that's what produces your higher highs, higher lows. So we've got a run on the left and then a trend on the right. Now, if this was observed on the monthly time frame, this would be just 1 monthly expansion. And that's where you're keeping that power of 3 in mind. So you've got your monthly expansion, power of 3. Where's that likely to expand to? Is that confirmed on the weekly? Is that confirmed on the daily time frame as well? Then your lower time frame reversal. So low time frame reversal occurs at a higher time frame PD array. Okay, so a key level. And a little light bulb moment is, if you look at the structure of that, that's actually an inverted head and shoulders, which is a daily swing low. And this example that's shown on this slide is, in fact, a 1-hour trend reversal. So you've got a shift in market structure where the short-term high is traded above. We have a retracement back down into the range, and then we've expanded higher for the full confirmation. So it's important to know that, I mean, if you I know I've just blasted through that, but there's no point in just hanging around really trying to long it out. I want to get straight to the point with this. But you've got to have that overall concept of where's the daily moving within the weekly, and where's the weekly and the daily moving within the monthly, and how does all of that line up together. And some of the cardinal rules that I use is we identify the market condition on all the time frames within our framework, and I'll go into an example of that. But just as an overview, you're not going to expect higher highs and higher lows if you're approaching the top of a range bound market. Okay, that's not high probability. We need to remember to look where price has been and where it's likely to go next, because obviously price moves from liquidity to liquidity. We trade in direction of the weekly expansion, and we anticipate the higher or the low to form at the beginning of the week. maybe on a Monday or a Tuesday, sometimes on a Wednesday, which gives us that power of 3. The highest probability trades are taken in the direction of the 1 hour and the 4 hour order flow when they align with that weekly expansion. Okay, so that's really important. You can take counter trend trades. However, in my experience, the highest probability trades are taken within the 1 hour and the 4 hour order flow. Now, there are exceptions to that because, of course, a lower time frame, micro time frame, like the 15-minute and the 5-minute and below, those time frames will reverse before the 1 hour and the 4 hour. However, they are always reversing, even when the 1 hour is simply pulling back. You're going to get a 5-minute reversal. So that's something to consider. And this is important. So once you've actually identified on the daily time frame where price is likely to expand to, you stick with that directional bias until you see an opposing swing against that direction, and or we trade into an opposing PD array or liquidity pool, which sounds super technical, but it's pretty straightforward when you see it. So that is the end of the example. Sorry, that's the end of the introduction and overview. So now I just want to thank you, obviously, for your concentration on that. And then let's move over into the charts to bring some of those principles together. Welcome to the practical example part of the video. So we're going to start off with just a simple diagram just to show you the theory of it. And we've actually got, this is actually a symmetrical move. So you've got AB equals CD. I don't know if anybody actually follows that, but this leg from A to B here is identical from C to D. So this is a retracement leg, this is impulsive, and this is impulsive. And we've got sell side liquidity here, and we've got buy side liquidity here. So let's just say, for argument's sake, we've got a fair value gap here where we've actually traded up into. Yeah, that will actually give you your buy side liquidity. And then let's just say that this was an old low where we've actually got current price action down there. So just quickly draw that in. 1, 2, and 3. Okay. So price is moving from here to here. And what we identify is we're looking for the sell side liquidity to be grabbed. And what I would do is I'll just make these a little bit longer so they're coming down into this key level. So this will actually form your swing low. Price moves from a swing low to a swing high. So I will draw this in here for completion's sake. And let's see if we can actually change the color of these. Okay, purple. There we go. These two ones evading the color change. So there you go. So price moves between a swing low to a swing high. And this would be a daily run. So we're not expecting any or many down candles. So as soon as we have a swing low form here and it's confirmed trading through candle number 3, our bias is bullish. I'm sure you'll agree that that is very straightforward. So I'll change that color now to purple. So we're actually trading between the swing low and the swing high. And obviously the significance is we've taken the sell side liquidity and now we're aiming for the buy side liquidity up here. Now, going up and down the time frames, as you'll see me do, is to identify where we are in the higher time frames. So on the monthly time frame, we've got the dealing range up here and here at current price on the US 500 or the S&P 500. And we've actually got a premium environment here on this leg down, and then we've got a discount area down here. So this is your discount zone. So we're looking at buying down here and selling up here. So as the price is in a downtrend on the daily time frame overall, then we'd actually be looking at selling up here. Okay. Price moves between a swing high and a swing low, or from a swing low and a swing high. So from here, if we had this confirmed, we would then be expecting price to come back down here. Now, the safer way of doing it is if we are in a downtrend, you see that this is going to be attacking the south side liquidity here. However, this is currently the dealing range because we don't know if this is actually going to form an OTE pattern. So what we're looking at doing is as soon as the market reverses here and it's coming back down again, we are anticipating this low to be taken. However, we are taking profits within this level here. But in terms of the daily direction, we are trading in between a swing high and a swing low always. And if that's in a range bound market, all we're doing, there's your old high. And let me just remove that. So this would be the dealing range. So this is the range high, this is the range low, and price is meandering in between them. So that's how you would do it. But obviously in a trending environment, then you're getting, in this example, it would be lower lows, lower highs. So once we actually have the low form here and we trade through that, this becomes the dealing range low, and this is the dealing range high, because you'd have another high here. So price is moving between those points now. It's nice and simple to see that. Yeah. And once we reach the buy side liquidity here, we're anticipating a swing reversal. But throughout the entire run here on the daily time frame, unless we see a reversal happen, we're always expecting price to go up and up and up whilst we're in a discount. And then once we reach a premium, we're looking for PD arrays in this price action here for where price could potentially stall or reverse. So if we go back to this, so we've got the dealing range, we've got the premium versus discount. The range expansion would be, if this is, say, 5 daily candles, this would be your weekly expansion from low to high, as previously mentioned. Deceleration and indecision would be anticipated in and around a PD array, which for argument's sake could be here. So let's just say, for example, this here is a fair value gap. There's your fair value gap high, there's your fair value gap low. In your price action, there's the void or the range. So once price trades up into that, into a premium in a down market, we anticipate the price to decelerate, to form a swing high here, and then to show some form of indecision here using your candlestick recognition. And then the next move we anticipate would be simply a move lower. So as soon as candle 3 is traded through, what we've done there is we've actually created a reversal in the market. And it's at this point that your daily bias changes. Okay. And then we're expecting lower prices to come down and to attack this low here, because overall the market is in a downtrend and it creates lower low, lower high, lower low. Now, something I actually got hung up on for quite a while was, I know that we get higher highs, higher lows, etc., but I never expected the market to follow through with that idea. So if I identify that this is in a downtrend and I get a reversal here, I'm not thinking, oh, it's going to stop about here. As long as I've actually got a clean reversal here in a premium environment with confirmation come through to the downside, I need to err on the side of probability, which is we're now looking for sell side and lower objectives. Because what's the point in having higher highs, higher lows in our minds with lower highs and lower lows for trend analysis if we're not actually going to rely on that with conviction? So once we actually reach this point here, it's only at this time here, once all of this makes sense, we've got this level, which would be your PD array. It could be monthly, it could be a weekly PD array. On this example, let's just keep it nice and simple. So this is actually a daily run down and a pull back up in an overall daily trend, which comes back down here. We've actually taken the buy side liquidity because we've traded into this fair value gap here. Maybe we've actually traded above that there before. So we've got an outside day here where we've taken the buy side liquidity of anybody that actually got this correct. And then we've had a follow through. And then what we're looking at doing is we're just looking at taking the market down just like this. And then you get your power of three. So your opening price, high of the day, which is the power of three principle, down and then close somewhere near the low. And then again, open, higher, lower, back down. And then we keep doing that until price either prints one of these here to show us potential that we do want to go higher, or we actually reach the sell side liquidity here. So price moves between buy side and sell side liquidity. We know that. Price moves between a swing low and a swing high in an up move, or a swing high and a swing low in a down move. We only change bias from the buy side liquidity. We're bearish, 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 bearish. It keeps going down, maybe stalls here, and then it comes back lower. And then we create this here once we've grabbed the sell side liquidity under this, and then we shift gears and anticipate the daily directional prediction to be bullish up to here using obviously market structure principles. So if you wanted to take a screenshot of that, and then taking that a little bit further, where we actually spoke about the lower time frame trend within a run. So this is just a collection of up candles, and I will show you a real life example of this shortly. So I'll start here actually. So we've got this here is, say, your 15-minute time frame, or your 4 hour and your 1 hour. It would be probably less lower highs and lower lows, just due to the fact that the 1 hour and the 4 hour are subordinate to the daily time frame. And then as we reach this, what you'll notice in price, and this is outside the scope of the daily bias. However, once we approach this high time frame key level, this is where you are likely to see a market maker buy model, and you'll have your original consolidation here. If this was true to nature, so you've got your daily rundown, you've got your 1 hour trend, you'd actually see a 5 or a 15-minute market maker buy model down here, where you get your initial consolidation there, and then you would have a run through that. Apologies. You'd have a run through that here, just for completion's sake. You'd have a run through to give you a fake move to the downside, and then that's where you would get your market reversal. So that is like the Russian doll principle, or inception, depending on how you want to refer to it. So you've got your daily trend, which is the purple. You've got your 1 hour and your 4 hour bearish trend, which is coming down, which realistically would have less lower lows and lower highs than that, but just as an example. So you've got your lower time frame trend coming down, and then you would get a market reversal here, and then you get the confirmation, and then this is your lower time frame reversal. And it's this on the lower time frame which creates the swing low, and then we get a run to the upside, and we just get the opposite of this. And that's as simple as I can make market structure, market reversals, but linking that in with the daily bias. So price moves from sell side to buy side liquidity. Price moves in a run from sell side to buy side. Within that daily run, you get a 1 hour and a 4 hour trend. So I don't want to be buying this because the momentum's to the downside. I want to be buying when we've got full confirmation here. And if you are up to date with the ENDS model, the backtesting that I've actually done, what ICT is teaching is you'd have a previous daily low here. So this would be your higher low to the left, your lower low and higher low to the right, which would be this one here would be candle 1, this one here would be candle 2, and this one here would be candle 3. And then you have confirmation of that, usually on day 4, but that can, in a strong market, give you confirmation on the 3rd candle. So that would just come up high like this, which is full confirmation within the 3. And until we see an opposing PD array within a premium, or we see an opposing swing high, we don't expect the market to reverse. This is always going to be a bullish bias until we reach this condition here. We see deceleration in the market, we see indecision, we have confirmation of a swing high, we have confirmation of a key level, PD array, and in this example, again, this is a fair value gap. So that's your daily fair value gap. And then you get your swing high, and then all you do is you just change your bias and you come back down again. So if you want to just take a screenshot of that, I've just downloaded it as well. So I'm going to clear that now, and I'm going to show you what that looks like in real life. So this is the example coming down, and then this is the daily run higher, and then this is actually going to be a poor example because of the news, but I want to keep it in the same structure. So we have the dealing range high, and that would have been a dealing range low originally. There's your swing low, there's your grab on your sell side liquidity. That's the trade up into buy side liquidity. There we go. And that is your sell side liquidity. So originally I'd got this as buy side liquidity, and then I would have been looking at the 50% mark here, this low as well, which is an old low. If you go down to the lower time frames, you'll see that price does actually move around that. And then ultimately the last objective would have actually been this high. However, we traded up to there with FOMC, and then we fell down. So bringing the principles back into the live example, we've got market condition. Clearly, we're in a downtrend, and in fact, one more day. Excuse me. So we'd actually got this swing low here. The higher time frame PD array was this old low. Okay, we've got this fair value gap here, but we'll keep it nice and simple. So we've traded into that. So we've seen deceleration after acceleration. We know that the market's stalling within this. We know that this is a PD array on this time frame. Let's have a look on the weekly time frame. Okay, so we've actually got this bullish order block here. Okay, so we've got a break and a retest trading into there. We've taken that weekly low, so we've got a higher time frame weekly. We've got higher time frame, which is the daily. So we're expecting the sell side to be grabbed, which we did there. Brilliant. And now in our minds, we are questioning why, if this wanted lower prices, why didn't we continue to go lower? So this is the previous daily low, although it's not the most previous day to this candle. So this is a previous daily low. We've grabbed the sell side liquidity here. So now we're on buy side liquidity alert. So we would have this in for buy side liquidity. And what we're looking for now is, because we've traded lower, is price going to continue lower, or is it going to give another swing low here, which is your 1, 2, and then a 3 swing? Okay, so what we've done is we've actually got a full confirmation on candle 2 here, because we've actually grabbed the near term sell side liquidity with that. And then we've got full confirmation because we've traded above the high of the previous day. And as soon as that happens, what we're now asking is, what day of the week is this? Okay. And then this would give us the low of the week if this was a Monday or a Tuesday. So when you're thinking of the weekly power of 3 and the weekly expansion, we're now expecting prices to expand higher. We've got a swing low. We know that price moves from a swing low to a swing high. Is there a swing high here? No. So we're anticipating the high of that candle to be taken. Previous daily high, bam, power of 3 down to the low, traded back down into this, which is actually a rejection block that I didn't cover. It's another ICD PDRA, and then we've traded higher. On the next day, previous daily high. Okay, is there a swing high? Have we traded into a premium PDRA? No. Boom. Okay, so now we've traded into buy side liquidity here. We've traded into this fair value gap here. Okay, that's your daily bearish fair value gap. So now we're anticipating a market reversal. So the next clear sign is this here and also this level. So because this one is lower hanging fruit, you'd have this on, or you'd have the mean threshold of that overall daily fair value gap. Price trades up again, and we've actually gapped now with hysteria. We've come back down to trade into this candle. We've traded to and through that previous daily high, and all this time we're expecting higher prices. And now this, based on the expansion or the range of these daily candles, this is within reach. So at 10 p.m. GMT, when this candle closes on market open, we're expecting price to make a quick run for this, really consolidate within this area on the lower time frames, have some trickery price action, and then we're expecting a swing high to form here. Okay, and then we actually had that. We all know, if you've been following along, this was FOMC, so this was actually really big news, and we've actually wiped out 1, 2, 3, almost 4 days worth of price action. This was actually a slow grind up as well. So that's what it looks like when you're just following the narrative on a daily time frame. However, here we go. So I'm going to delete that, and then I'll just clean this up a little bit. So what's happened here is we've had a shift in market structure on the 4-hour time frame. So we've traded lower. We've actually created relative equal lows here. So this looks suspect. Now, if I go back into this, we've covered premium discount, expansion, power of 3, acceleration, deceleration and indecision, swings, PD arrays, a run is a trend. This here is a run. This is a run, okay, because there's no swings here. Yes, there are highs, but there's no pullbacks like this. So this is a daily run. And you look at that now, you see how that daily run is actually a 1 and a 4 hour trend, lower lows, lower highs, all the way down. And then where we've actually traded into that sell side liquidity, we've taken the liquidity under here, the previous weekly low as well. So there's sell side liquidity under there, and we've actually had confirmation on the 4 hour time frame that this is a shift in market structure. So upon this here, with the anticipation of prices to trade back into here, we shift our bias to bullish until we reach those higher objectives. So if I just go back to this, we've covered all of that actually, fantastic. And just trying to think if there was anything else that I didn't cover. Let's have a look, see what that looks like on the weekly time frame. So yeah, so originally I was actually expecting prices to reject this level and to continue higher. However, because we've actually got this imbalance here, I wasn't actually planning on holding anything through this area, because this would have actually been a dealing range. So you've got a weekly dealing range here, and if prices are to remain bullish, then we would expect this to hold here. So this took the sell side liquidity below these relative equal lows on the weekly. We've expanded higher, we've taken out this short-term high, and we're actually retraced back down. So this could just be a complex pullback into this before we see higher objectives, or we could just be running the low here and a continuation. Obviously, we don't know that, so you need to anticipate those things, and we need to consider what's happening here. So at the moment, this is 3 p.m. GMT. We're actually trading. We've taken the buy side liquidity on the near term because we have this small dealing range here. You see that? So we've taken the buy side liquidity because we traded into this fair value gap on the daily. Let me just move some of this. So we've traded back into this range here, and then we've traded lower. We've taken this out. We've created another bit of a range here. So you see how the range is getting much tighter here? Then we've traded back into it, and now we're looking for sell side liquidity. So if this actually produces a swing low here, one could argue that we do want to trade up higher, maybe into this here for your buy side liquidity. So brief summary, because I know it's a long video already. Price moves from buy side to sell side liquidity. Price moves within ranges. Price can move sideways in a range here, or we could expand higher, or we could expand lower. So you're using market structure on the daily time frame. You also need to be considering those higher time frames as well, the weekly and the monthly. That draws an end to it. I hope you've actually got some benefit from it. This is probably the 9th time I've recorded this video, and hopefully you've enjoyed it enough to get the value from it that was intended. If you haven't subscribed already, which is about 75% actually of my viewers, please subscribe, because this is actually the first of many in a new feature topic series that I'm going to maintain. And every single week I do actually do a market recap and a market prediction that's going to help you build on the foundations of these lessons. Feel free to share the PDF, but please don't try and change it so I lose credit for it, because it actually took me some time to bring that together. And I would really value any positive criticism in the comments below, any feedback, things like that. And please like and subscribe. And until the next time, Thank you and good trading.